Mills Corporation acquired as a long-term investment $240 million of 6% bonds dated July 1st on July 1st, 2018. Company management is holding the bonds in its trading portfolio, so these are treated as trading securities. We will take fair value into consideration. The market interest rate yield was 4% for bonds of similar risk and maturity. So market rate will tell us how to calculate interest revenue on the income statement. Mills paid $280 million for the bonds, so payment is the price of the bonds. The company will receive interest semi-annually on June 30th and December 31st. Therefore, when we calculate cash interest, we will use 3%. When we calculate effective interest, we will use 2%. As a result of changing market conditions, the fair value of the bonds at December 31st, 2018 was $270 million. Unlike the previous problems where companies will hold the bonds until they mature, in this situation, as trading securities, we will report these bonds at fair value. Requirement 1 and 2 asks us to prepare journal entries on July 1st when they first purchased the investments and when they receive cash interest. Interests are based on effective interest rate method. Since the problem doesn't tell us whether the company uses straight line method, we assume it is based on effective interest method. Effective interest method needs amortization table. The bonds were issued on July 1st, 2018, so the starting date is July 1st, 2018. Mills used $280 million to buy these bonds, so initial outstanding balance was $280 million. Interests are paid on June 30th and December 31st. So the first payment of interest happened after July 1st is December 31st. Cash interest is stated rate 3% multiplied by face value $240 million. Effective interest rate is the market rate 2% multiplied by previous balance. Difference between cash interest and effective interest are calculated by larger number minus the smaller number. And because the face amount $240 million is smaller than the starting point $280 million, we know the balance should be decreasing. So 280 minus 1.6. Therefore, issuance of the bond, issuance date, the purchaser, the buyer of the bonds, receives a receivable in the future. That is an asset. We call it investment in bonds for the face amount. They paid to buy these investments, so they credit cash for $280 million. The difference needs a plugin on the debit side. The issuer named the plugin as premium because the face value of the bonds were $240 million, but the issuer received $280 million from the buyer. So the buyer investors follow the name of the issuer, premium. The second journal entry says to record interest. December 31st, they received cash of $7.2 million. Effective interest is the interest revenue on income statement. So we credit interest revenue. Difference is to amortize premiums or discount. In this case, they have the premiums on the debit side, so we credit premiums for $1.6 million. The third requirement asks us, how much should we report for these investments? Because this is trading security, we report them at fair value.